Hey guys, John Paulamy here, Actionable Intelligence. Today is July 5th, 2020, and this is the weekly market update. So, first of all, happy Independence Day. I hope you guys are having a good weekend. Beers, brats, steaks, ribs, the whole shebang, setting off fireworks. I know this is a tumultuous time right now in our history, but it's time to take some time out and appreciate what we have, not necessarily what we don't have. So, again, in the spirit of looking at things for what they are and not the way we want them to be, we're going to get into the reality check this week. So, as I've said before, I subscribe to a guy named Steve Blumenthal. He comes out with a weekly market update. It's pretty good. He's a pretty plugged in guy. I'll put a link in the show notes. I suggest you get his email. It's pretty good. But this is from his missive this week, and he's just quoting a couple people here. The first quote is from Jerome Powell, who's the Federal Reserve Chairman. And the second one is from Jim Bianco, who's president of Bianco Research and a regular commenter on the internet about economics and the markets. So here's Powell first. I don't see us wanting to run through the bond market. This is referring to the bond market purchases that the Treasury's making with printed up money from the Fed. Basically, that's illegal, by the way, not allowed, but they've skirted that with those special purpose vehicles. But anyways, I don't see us wanting to run through the bond market like an elephant, doing things and snuffing out price signals or things like that. We just want to be there if things turn bad in the economy or if things go in a negative direction. We want to make sure that, we are there. So Bianco commented on this and he says, to emphasize, in parentheses, just want to be there if things turn bad. And Bianco asks, doesn't this translate into an investors will not lose market, which retail understands is why they are killing themselves to get in? Well, that's how I take it. We're in a situation, I think, where a lot of these people, when I say these people, I'm talking about the Federal Reserve and people in the government, people in the Treasury Department. These are all people that used to be in the private sector, in the financial markets. The Goldman Sachs, New York nexus between Washington and Wall Street is intact. And, the next slide, I think, emphasizes this. This is what the Fed has been buying, or the Treasury's been buying. For example, this is the ticker symbols of the ETFs, bond ETFs they've been buying. Here's the percentage of ownership they have. Here's the investment class, and you'll see high yield. When you see high yield, that means junk bonds. So they've been buying a lot of, bond ETFs. They haven't really spent a big slug of their money, but they don't have to right now, right? Because all they had to do is announce it, and a lot of people did the front running, and then they just buy selectively, and then that pushes corporate bond yields down. And that's the effect they get, because this illusion that the Fed's in control and the Fed has their hand on the tiller doesn't require them to put massive amounts of money in there. The knock-on effect of this is several. I mean, first of all, this is more intervention into a market. There's never going to be, I don't think, for forever now, going forward, market clearing events. There's not going to be bankruptcies of major companies or industries going to be allowed, or we're going to do everything we can to hold it back. The market clearing mechanism of saying, mismanaged companies that are too far in debt, companies that are in dying industries are not going to be allowed to fail like they should and have the capital, both human and financial, be recycled back into new ventures. We're not going to have that because that's painful, and we're not allowed to have any pain anymore because that could, jeopardize some politicians' electoral prospects, and and also possibly damage the bonuses of the one percenters, of the schickimicki, Wall Streeters. So obviously, the Fed's gambit's working right now. They didn't have to commit all their funds. I mean, it's a $300 trillion debt market in the world, right? So they had $250 billion. They made their announcement. They say things like they have unlimited amounts of money that they can put into it and things like that. And people believe this stuff still because it works, right? The Fed says jump, the market jumps high. So the knock-on effect of this, though, is that we see something like this. We have record junk bond sales. So we have a situation where because the Fed is backstopping the corporate bond market, we're in a situation now where companies that probably shouldn't be in business, i.e. zombie companies, or companies that are having a hard time, instead of folding up and going away, they're able to issue more debt. It's a Bloomberg article, link in the show notes. Junk issuers have already sold $46.7 billion of bonds in June, surpassing the prior monthly record of $46.4 billion in September 2013. And there's, I think this is an excellent quote from this high-yield bond portfolio manager, Bill Zox. Quote, "You get an invitation to a party from the Fed, Treasury, and Congress. They offer to pick you up, take you home, and bring you breakfast in bed the next morning. You know it's going to be a party like no other," said Zox, whose firm oversees more than $20 billion in assets. This is exactly it. I mean, this is it in a nutshell. The Fed has told you they are going to do all the heavy lifting. All you need to do is front run them, and you got guaranteed profits. You just made your year. Okay, your big bonuses and your weekends and summers out in the Hamptons and doing whatever you want to do, and the wealth gap continues to grow. How is this productive for the overall economy? Supporting companies that probably shouldn't even exist. But we're in an election year, and we can't have unemployment. We have self-induced depression, and we're going to pull out all the stops. We're going to throw caution to the wind. And my suggestion is that this has consequences. This is not how things are supposed to be. Now, because you don't see the immediate effects doesn't mean that the call is wrong. I think it is. I think that this is going to manifest itself. All this printed money is going to manifest itself in a bad outcome for the average person. And I think that's being reflected in hard assets, specifically gold. I mean, things have been in the stealth bull market. No one's really talking about it. Here's another thing that the government's doing. You have this company, YRC Worldwide. It's a trucking company. It's a company, you've seen them. They have those day trucks. They pull half loads around, and the government's bailing them out. YRC Worldwide said on Wednesday it would give the U.S. government a 30% stake, basically, in the trucking company in exchange for a $700 million loan, tapping into a $17 billion bailout fund originally intended for defense contractors such as Boeing. YRC was on weak financial footing even before the coronavirus-induced economic downturn. Why? Because its cash flow had declined while its debt pile soared. So here's a company that should go out of business. It should go out of business, and the managers there should lose their job, the assets should be liquidated, and the stronger players in the industry will take over their market share, or new companies will spring up to take their market share. Okay, people will be rehired to do those jobs, and you get rid of a weak competitor. Instead, we have the U.S. government. I mean, this is like what went on in like Italy, in Germany in the 30s, right? The government would support certain industries. It was a fascist type situation. And people are saying, "Well, John, you're going out on a limb now." No, this is what I'm talking about: the melding of big business and government. Okay, with government ensuring through loans, guarantees, regulation that certain companies and industries are going to survive because it's politically expedient because we're in an election year. And look what they've done. They had a $17 billion bailout fund that was originally intended for defense contractors, such as Boeing. But Boeing went out on their own and did their own bond offering and didn't need to tap into this. So they had to go find somebody to use the money, right? So we've got the U.S. government now taking a 30% stake in some trucking company that was on the road to failure even before coronavirus. Do you see how rigged the system is? Do you think this is the way that a leading economy in the world should be operating? Yes, it would be terrible if you worked at YRC as a truck driver and you lost your job. But that doesn't mean the demand for the trucking goes away. You'll get a job with another trucking company that would move in and take the market share, or a new company, or you would create your own business. I mean, that's how a capitalist system works. Instead, we have so now what's the government going to do? Put a couple board members on there, and then what are we going to do? I mean, I guess it's fine in this particular administration, but what about the next administration? Are they going to demand certain? I mean, you can just play this out like how you want in your mind, and this is what we see. And where did the money come from, anyways, to do this? It's printed out of thin air. I mean, the whole thing is a spectacle. It's a farce. But again, I point these things out not because I want you to write letters to your congressman, or we're going to vote, for a certain person for president and they're going to change all this. This is how it is. And what I'm telling you is that this is going to result in big problems down the line, specifically price inflation. It's stagflation in my mind. And I can find examples after example like this. So this is a quote from another article that I read this week on a website. I think it's called Down the Rabbit Hole or something like that. But I like how this guy kind of flipped the name around from MMT, modern monetary theory, or some people call it magic money tree. But I like what he calls this total market manipulation. And that's basically what we're talking about here. We have this market manipulation going on with this levitated on hope, dreams, and printed money, where the economy, the fundamentals of the economy, the structure of the economy, the underlying foundation is being eaten away. But we're levitating this whole thing on basically doubling the Fed's balance sheet in the last 3 months. And everybody just thinks that, hey, I guess it's going to work till it doesn't work. But I like what this guy says. But here I'll repeat that the Fed is balls out printing money, really funny money, manipulating Treasury and corporate bonds, and stating that it will have virtually no limits in this MMT. I would turn around MMT to call it what it actually is, TMM, or total market manipulation. They can give it a fancy name like modern monetary theory, but by any other name, it is chicanery and a scam that society will suffer the fallout from someday. They are cheapening the money units in order to give the appearance of rising asset, especially stock asset units. Say it again. They are cheapening the money units in order to give the appearance of rising asset units. Hence, gold, the shiny rock, the bullion, the anchor to monetary sanity. In this surreal monetary realm, it is something real. And that's what we've been preaching here. We've been saying that, we are in the midst of probably going to be the biggest gold bull market of our lives. Gold, because it can't be expanded as quickly as paper currency units. They can be, on a computer digitally increased infinitely, but you can't do that with hard assets. And that's what we're advocating for. I think this ensuing decade that we're facing is going to be a decade of hard assets, because not only are you going to have supply destruction from lack of investment, but you're going to have this wind in your sails for the entire decade of all this money printing, not just by the United States, but every central bank on earth. I mean, at some point, this has to end in some type of debt reconciliation or restart or jubilee or whatever you want to call it, okay? But I don't know how that manifests. I don't know how that gets done. I don't know what the end game is. All I know is that the world central banks continue to print more and more money. Here is a chart of the major central bank balance sheets. These are just like the big five, right? You've got in blue here the Fed. This is the 2008 crisis. You see the little blip here, but look what's happened in the ensuing 10 years. They haven't stopped printing money, and we were supposedly in the best economy of all time. We were in a recovery. I mean, look at the amount of money printing by all these central banks in total since the 2008 financial crisis. Whole 10 years 12 years has been a scam. It's built on printed money. Now look what's happened just in the last few months. I mean, this thing's went exponential. The Fed, ECB, Bank of Japan, Bank of England, Swiss National Bank. And they've taught us all the lessons, right? I mean, the Japanese were buying bond ETFs years ago. They're buying stock ETFs now. The Swiss National Bank, they just print Swiss francs, convert them to dollars, and buy stocks on our stock exchange like Amazon. You can go on their website. Well, you can look this up. I haven't done it recently, but they kind of list, the amount of shares they own in all these major stocks. I mean, this is just crazy. And we've seen the emergence now of the Robinhood traders. We've seen the Dave Portnoys. We've talked about that. This is not normal, guys. Especially you young guys. I'm not telling you, you got to go where the action is. I get it, but you have to be really, really wary. You have to understand that this is not normal. And this is not going to end well one way or another. I like gold. I've talked about it. I've been increasing the amount of gold shares, gold stocks in the portfolio, actionable intelligence newsletter portfolio. This is the price of gold. You can see it's going back to back in the 2019, it's like a year and a half. It's been, we had the little drop here. This is what happens in a liquidity crisis, but you've seen what's happened in the interim. And last week, gold intraday traded, 1807 intraday. And like I said, gold is making new highs in most currencies around the world, and it's going to make new highs in the US dollar. It's just inevitable with the amount of monetary chicanery that's going on. Malfeasance, irresponsibility. And the gold stocks have been moving, but they really haven't went into that mania yet. And think about what could happen if these things attract the attention of this new class of Robin Hooders, the Dave Portnoy disciples, and this thing gets some momentum behind it. This could blast off, and I think it eventually will. I think it eventually will grab the attention of these folks, and it's going to go, and you have to be positioned. What I'm concentrating on now is a lot of mid-tier or smaller mining companies that have a current producing mine but yet have upside exploration potential. They have optionality to the upside because they have a surrounding property portfolio that they are drilling and trying to increase, or they have additional projects that they're working on that they can recycle cash from the current operating project into exploration and increase through their drilling, increase their indicated and measured reserves to try to increase the value. And I think when this thing gets traction, gets purchased among investors and speculators, this thing's going to take off. And I think this is going to be a tremendous bull market in these stocks. It already is. A lot of them are up massively. You could have bought a lot of these stocks, and I did buy some down here near the lows. And you've got stocks that are up, 100, 200% since the lows here. But I still think that the massive gains are going to come. You're going to get a blow-off run in these things once these people get behind it. Now, do I think that some of them are overbought? Yeah. The tracking mechanism for the bullish percentage of gold stocks is like at 100% right now. So would I be buying gold stocks now? But I'd be putting my list together. I'd have my list ready, and on any pullbacks on any prices, I would be buying. Nothing goes straight up, nothing goes straight down. You can see this thing, the general trend. We're for trend following here. This thing's moving high, 200 days in advancing, the 50 days in advancement. This is way a bull market looks, right? And yet no one's even talking about it because people are buying bankrupt companies like Hertz. I was listening to Cuppy yesterday on the Market Huddle with Kevin Muir, and he was talking just one little vignette. He was talking about people DMing him. He can tell, like some of these on Twitter, some of these Robin Hooders asking him, "Well, can you unbankrupt a company?" And they're talking about Hertz. These people do not understand what they're doing. It's just like watching a video of like a drone watching sheep being herded. They're just wherever they're told to go by the Dave Portnoys and other people that they're following blindly, that's where they go. But it's a tremendous amount of people, even with small accounts. You're not talking people with accounts with hundreds of thousands of dollars. It's $1,000, $2,000, $10,000 accounts But if you've got 1 million of these people, or if you've got 500,000 of these people, and they go into one group of stocks, you can see what happens to Hertz, a company that is functionally bankrupt, and there is no value to the equity holders, yet this thing's being traded. It's unexplainable. It's inexplicable. But this is the world we live in, so we need to take advantage of it. So what have I been doing? I've been, there's the volatility is looking pretty good on some stocks. I've been writing puts on certain companies that I want to own. I'm getting nice premiums. If the stock gets put to me, then I'm happy to own the stock at a lower entry price. If the puts expire worthless, I'm happy to capture that premium and earn, my 8 to 10% a month and continue to do that. Now, if you don't even know what I'm talking about, maybe I'll give a video about it if people are interested, but it's something you have to be careful about because it can really wipe you out if you don't know what you're doing. You should, when you're buying a put, you're saying you're giving the buyer of the put the right but not obligation to put the stock to you at a certain price within a certain amount of time. And I'll go into it in a video. But that's what I'm doing. I'm doing things like that. I'm generating revenue that way. I've been doing that for a while for stocks that I want to own anyways. So, I'm doing that. I've been slowly increasing my shares in select energy, oil, and precious metal stocks that I think that are going to do well. I mean, is anybody paying attention? West Texas Intermediate was $40 a barrel now again, slowly creeping up as the lack of investment in the market and the drilling rig count stays down as production drops off and this demand starts coming back. That's going to intersect and we're going to, that's starting to have an effect, right? It's going to take time to balance out. So those are some of the things I'm doing now. Speaking of oil and gas, people have said, well, we're just going to come right back as soon as prices go up. Well, we have to be careful when we're saying that because what happens is twice a year, what happens is these oil and gas companies have what's called a borrowing base with their banks. So they sit down with their bank and they say, here's our assets, here's our production, here's our projected cash flows, here's how we're looking at things. And we want to set up a line of credit with you, basically, a borrowing base. How much can we borrow? And the bank will look at everything and they'll have a negotiation. They'll say, okay, based on everything that we see here, we'll give you a borrowing base of like $500 million and we'll look at it again in 6 months. So what's happening is they're coming under those reviews and what's happening is the banks are cutting back. They're cutting back on the borrowing bases. They're cutting back on, they don't want to have as many oil companies in their portfolio, oil and gas companies, because they've been burned so bad. So what that does to my mind is kind of, if prices do turn around, it's not going to be immediate ability for new money to go into drilling. Yes, drilling will come back if prices go up. But if you're restricted by your borrowing base or some covenants that you have on your current base or your current borrowings, that could limit what you're doing. I mean, let's just face it. We've talked about it the last couple of weeks. I mean, none of these companies, for the most part, the industry as a whole has not cash flowed positive. This is not impressive to the banks. After 10 years of no profits and a lot of companies, no cash flow, positive cash flow. So I wanted to point that out. I'll put the link to the article in the show notes as I always do. But this is something to keep in mind, right? I mean, people aren't thinking about the knock-on effects of this stuff. Now, with the Fed stepping in and buying junk bonds, will the shale companies be able to go sell junk bonds? That remains to be seen. We'll see. That's one of the things I'm nervous about. But we have to watch it because there's a lot of debt coming due for a lot of these companies. And if they can just sell more junk bonds and the Fed will step up and buy them, then we can keep the plates in the air. That's what they'll try to do, right? But I think we're getting to the end of the madness on that. So that's pretty much it for this week. It's just a continuing of the manipulation, the continuing of the monetary malfeasance, the fake economy. But like I said, I'm not here to, it is what it is. You've got to take it as it is, not the way you want it to be. And now we've got to start incorporating risks in for the election. I mean, if you're an energy investor like me, I mean, the best thing that could happen would be a Joe Biden presidency coupled with a flip of the Senate to Democrat and of course the House remaining blue, I mean, you'd see a ban on fracking. You'd see, I mean, energy prices would go through the roof. So, I mean, that would be good. I mean, would I think that'd be best for the country? No, but people get what they deserve in life, not what they want. And if they want to have a change, they better be careful for the change that they're going to get, and they should listen to what these people are saying they're going to do. So, a lot of things coming into play, a lot of inputs of information, but we need to look at it rationally and look at it for what it is and not what we want it to be. So that's it for this week, guys. Again, going to be putting out the new issue, the July issue of the Actionable Intelligence Alert. Like I said, I've added a gold stock last month. I'll be adding another gold stock this month. I think that would put like 4, 5, or 6 gold companies in the portfolio. I'm really stoked on gold going forward over the next, 3 to 5 years, 10 years. I really think it's going to revalue upwards. I mean, I'm talking, the possibility of getting to the thousands of dollars. So, something to take a look at if you're interested. So that's it for this week, guys. Appreciate it. We'll talk to you next week.